Unmute.
Turn it unmute. We unmuted?
Yep. Just ask everybody if you can.
Yeah, welcome, and let's do a test here before we get started. Audio test. If you can hear us, what do you need to do, Trey?
Type in the chat whether or not they can hear you.
Type in the chat. Yes, we can hear you, Tony. No, we can't. Of course, if they couldn't hear us, would they be able to type anything? I guess.
You know, old sign that.
Yeah, sound like.
Write it on the whiteboard.
I know TONY. I learned that in elementary school.
Sounds good.
Sounds
So,
good.
thank you, Teresa.
Thank you, Teresa.
And John.
John, good to have everybody with you. We're going to kind of start with just some basics while people are coming on. This is our fourth webinar, live webinar, Trey, something like that. And we have in the studios here local. We do these live from our Worry-Free production studio. We have Aaron Orander with us. We have Megan Murphy. We have Renee Napier, who just started with us. She's in the studio. And then, of course, my favorite son-in-law, Trey, who's actually helping with the controls, and he'll be taking your questions. So as I go through this, if you have a question, Trey, you want to tell them the best way to get us a question?
Yes, the easiest way to get your question to Tony is just using that same chat feature. You can use the Q&A feature, but it's easiest to get the chat feature. So just type your question in there. We'll get to as many as we can. We also have a few that were emailed in ahead of time. So appreciate the Q&A.
And real quick, let's go ahead and jump in. This is the topic, folks. And first of all, before we get into safeguarding your 401k from the next stock market crash, here's the bottom line. This is the truth. Nobody knows. Nobody can time with the stock market. So in fact, before we came up to do this, I was just kind of Googling around. The Dow's back up today. I thought, okay, why is the Dow back up? Apparently the tariffs have been postponed with China on cell phones or whatever. It's like, I mean, come on now. I mean, this is so volatile nowadays. So what we're talking about is not we're going to predict what happens with the market. We're going to tell you what has happened with the stock market. And then, Aaron, if you can hold it down over there, it's getting feisty. In fact, let's go to our first slide here as people are coming on. Just a couple of intro slides here. Megan, if you could shoot them. Yeah, we wanted to remind people before we get started, we are on in 7 major networks now in the Kentucky area. The TV show, The Worry-Free Retirement. The various times are listed there. You can go to TonyWalkerFinancial.com. Also, we have a YouTube channel, so you can go to YouTube and type in Tony Walker Financial and watch past episodes. And we don't have the radio shows up, do we? But we've got 3. Yeah, that's okay. There's 3 radio shows in LAP and Langston. What is the BRT in Bardstown, and KCT in Bowling Green. So we're on the radio show, The Worry-Free Retirement. Next slide, Megan. We're excited about our staff. You know, one of the things I've decided to do, and there's no right or wrong answer here. A lot of firms, though, grow their firms by continually hiring more and more advisors to get more and more business. What we tend to do is get more and more business, and I want to stay in touch. So I'm the main producer of fiduciary. What I've done is I've hired more people to provide support services, because retirement planning, folks, is not just about rolling over your 401k. Anybody can do that. I could train Aaron to do that. Where it starts is once you roll it over. Then that's where you have to have the expertise. And I've got currently, of course, Aaron and Megan are in a separate corporation doing the productions. But basically, beside me, there's 10 staff people that work with Tony Walker Financial. The other fiduciary in the office is Heather Hughes in the Bowling Green office. Her role is when people become clients, if for some reason they have questions, they can kind of run them by Heather, and then I get involved as I need to. So the process works really well. If you decide to meet with me, you'll have that opportunity. You will meet with me in person. I take you through the entire process. So that way you get to meet with somebody with 35 years of experience doing this, and there's no charge for that. So in essence of time, let's this picture is kind of a panoramic view of panic is what it is. I don't know what first thing, I look at this guy. I don't know why I'm attracted to this guy. He's like, oh my gosh, folks, this is how people feel when the market collapses. And it can happen. It has happened. More than likely, we live long enough, it's going to happen again. The market goes up and the market goes down. The question is, if you're nearing retirement or already retired, this is not a pretty picture. Next slide, Megan. Now you might say, well, Tony, there was only one crash, wasn't it? The 30s and then the 08, I remember that. No, if you look at this, and we'll show you this in more detail, but look at all these ebbs and flows. These are when the bull markets hit. This is going back to 1930, 1940, it went down, 1960. All those red lines going down. Let's go to the next slide, Megan. It gets pretty dramatic here. Now, again, picture you're retired, or you've recently retired, or you're thinking of retiring, maybe you're age 60. Okay, so you've got to get your frame of mind wrapped around that age. If you're 35, this probably doesn't concern you a whole lot. But if you're 55 or older, it should. So look at this. We go back in time And what they've done, they've quantified these periods. And these periods of downturns, look how long some of them lasted. Back in 1938, it lasted 871 days. 2008, people forget, 2007 to 2009 was 355 days. This was a biggie. People forget about 2000 to 2002. That market downturn lasted 685 days. And look at these losses. You could have lost as much as 53% in 2007. And we did have people, quite frankly, who would not listen to us back then. We were encouraging people to get their money safe because they were nearing retirement and nobody thought about it. And then it was too late. The market crashes. Again, nobody can time the market. I remember those days. Nobody saw this coming. Don't sit out there and act like, yeah, I was one of those advisors who told everybody to get out. No, you weren't. Nobody was. I remember that. It was very, very challenging to get people to pull some winnings off the table. Here we are again. Dow's at an all-time high, and people are scared to pull any money off the table. It makes no sense to me, and we'll show you why you don't have to take all this risk with your money. Okay, so what we're doing here, we're imagining that you got ready to retire. We have to go back prior to 2008. That's the only factual evidence we have of a downturn. But let's say you retired, that would be roughly 2005, and you were 60. You said, oh, I've got plenty of money, I can make it work. So you rolled your 401k of $300,000 into the market. That year it makes 4.9%. You need $20,000, but hey, you've got $293,000. Not bad. You say, oh, I've got some money out there. I'm still technically ahead. I took out 20. I've only cost me 7. Next year, even better. The market that year went up almost 16%. It easily covers the $20,000 of income. You're up to 316. You're a happy camper. Let's go to the third year. Again, you start at 316. The market that year before 2008 went up. You took out your 20. You're still ahead. But let's slow down a minute. All right. You're having fun. You and Martha are traveling. You're thinking, well, this was a great idea to retire early. We've got it whipped. We're worry-free. Now let's see what happened in 2008. You lose 37. Now again, we saw that. A lot of people lost more than 37%. This was just the S&P. You could have lost more. You still need 20,000. It's not going to be reassuring if your broker or advisor just simply says, hang in there. You need money. The problem is once the market goes down, remember this is all on paper, folks. It could go down in a heartbeat. You pull out your 20, you're left, again, at age 63 with a whopping $184,000 of your original 300. Again, could this happen? Absolutely. Will it happen? Don't know. When will it happen? Don't know. But that's why we got to take the mystery out of this and start locking some of this down into safe territory. Next slide, please. So where did this all start? Well, a lot of this starts from Wall Street, from financial advisors who, quite frankly, years ago when the industry shifted over to fees, I believe it was really tarnished our industry. It used to be brokers, people like me, we all worked on a commission basis, and quite frankly, I thought that was better. You knew what the commissions were. If you moved money, you paid a commission. There was accountability. If the market went up, fine. If it went down, fine. But it doesn't work this way. Now, Wall Street's learned to bait all these people with fees, so they just keep asking you to hang in there. Don't take it. Let it grow. If it goes down, don't worry. Hang in there. Well, obviously, they're going to tell you that, folks, because they're making 1.5% to 2% a year, whether you make money or not. This is not a good strategy for savers. Next slide. We, in fact, even quantified this. One of the money managers, we recently looked at some of their information, charging 1.5%, and on paper, that doesn't sound bad until you put numbers behind it. So same thing. Imagine in 07, you roll over your 401k, you're all excited, you're 65, you've got everything set up, and you put it with a money manager, all right? And the money managers, we've had great success in the market, keeps it there, you make $22,000. Again, remember what it went from 2007 to 2008. These are factual numbers. 2009 hits, look at that. Your 500's down to 323. Problem is, okay, when you do better, they do better. When you do worse, they still do better. Yeah, in this case, they still charge almost $5,000 just to sit around and watch this thing go down. I don't think this is what I would call a game plan. It finally tries to trickle back up here, but it's got a headwind, right? Because it has these fees dragging against it, so it's having trouble getting back to break even. In the meantime, you're retired. Again, and I went through this. I managed money in the 90s, folks. When they flew into those Twin Towers, my response to people was hang in there, it'll come back. Well, it's easy for me to say. It wasn't my money, and this is why we went to a safe money approach. If we keep climbing up here, finally, all right, 2013, finally, you're ahead of where you were here, but look at this. Here's the sad truth. After all that, those sleepless nights, after all that worry, you've made almost $27,000. The advisor, who brought nothing to the table, did not work for this money, had no skin in the game, no risk. They made $41,000 on your money. Now, folks, this is how the financial world operates, and you have to understand the rules of the game. Next slide, please. What we do in our office is we have a platform through Charles Schwab. Obviously, most of you know we write a lot of annuities, but we also have the ability to go through Charles Schwab for people who do want some money in the market. Now, this example, we went through a detailed analysis with somebody that had all of these funds. The advisor they thought was charging 1%. Turns out we found out they were charging 1.4. By the time Heather and office analyzed all the funds and the expense ratios and weighted those out, they're up to 2% a year in fees. So it's even higher than 1.5% once you bring in the middleman of the fees. Now look at the Charles Schwab platform. By the way, if you see any of these symbols, this is not a recommendation to buy or sell. Don't rush out and get any of these. These change all the time. These are just symbols of some of the funds we had picked for this portfolio. But look at that. The difference, here's an expense ratio of 1. Look at that with Charles Schwab, 0.06%. That's almost nothing. So you come down here and look at our fees, 0.6%, just on an account of $128,000. Think if this was a $500,000 account. Just on that account every year, we've saved them $1,700 per year in fees. Now, folks, I don't know about you, but that's a lot of money, especially the more you make, again, the more they're going to take. The more higher the account, the higher their fees. So it's important to keep those fees down. Next slide, please. Our philosophy is totally different. After doing this for 35 years, after doing 4,000 game plans, after meeting well over 10,000 savers, all this can be documented, by the way, we decided years ago when I started meeting people and see people slow down as they get older, I call it the second half of life, we decided to quit taking all that risk and encouraging them to spend money while they can. In our office yesterday in Louisville, I had 19 30-minute appointments. I was here until 8:30 last night. One of the couples that came in said, Tony, man, I'm really digging what you're saying here. They were in their early 60s, getting ready to retire. She had just visited a friend. Her friend lost her husband 2 months ago. The other friend recently lost a husband a month ago. Both husbands in their 60s, all right? So it does happen. You can save all you want to for down here in your golden years, and a lot of times they ain't so golden, folks. Some of you aren't even going to make it to the golden years. So there has to be a balance of using and enjoying your money and then protecting it with what we call mailbox money so that you don't run out in case you do live a long time. Next slide. So what are the Savers products? What does a saver really love? Remember, a saver, that's who we work with, is defined as someone who is more concerned with the return of their money than on it. We like to say in our office, unlike money managers who are willing to try to grow your money at all costs, we're trying to protect your money at the least amount of cost, a huge philosophy difference. But basically, we're big on certificates of deposit, money market accounts, and savings accounts, all right? We like those accounts for savers. We're big on government-backed securities, such as government bonds, treasuries, etc. We use those. Obviously, we're huge fans of what's called fixed annuities. We don't do variables because of the fees and the risks. So fixed annuities, fixed interest, fixed index. And then finally, sometimes we will put in ETFs, dividend participating stocks, higher dividends, good value stocks. Not a lot of that, but we can do that. Again, we have some portfolios that are fairly aggressive, but we temper that to make sure the rest of the money is safe. Next slide. We're kind of getting known for this. A lot of people use buckets to explain retirement planning. That's nothing new. The way we do it is, though, we use the low-cost fee account of the Schwab over here. Gives us all the flexibility we need. So the next time you hear somebody say, your annuity's all tied up. Well, it's all tied up if you don't have a game plan, but we know how to work with these annuities very well. We take advantage of the 10% penalty-free withdrawals within the annuities. We know when to access the income, and more importantly, we want that annuity on the back end so as you get older, you'll have that money that's guaranteed for the rest of your life. It was funny, Trey had somebody come in yesterday and they purchased an annuity, and apparently an advisor looked at it and said, well, when you're in your 80s, you're only going to get like $13,000 a year. That's not enough money. And I said, well, I don't know if it's enough money either, but what's he going to do? What if you run out of money? That'd be even worse to me. So at least we can guarantee, and she knows what she's going to get. She said, yeah, I'd rather know what I'm going to get rather than leaving this to chance. Next slide, please. So what we suggest, here's the purpose of this. If you are 59 and a half or older, more than likely, if you have a 401k, we can roll that over into our process. If you have, Trey had one the other day, somebody contacted us, this person's only 40, but the person had left their prior employer, still has a 401k, we can move that into our process. Obviously, if you're retired or retiring soon, or you've been retired for several years, and have an IRA, 401k, TSP, lump sum pension you're thinking about, let us look at putting this in our process, the Word for Retirement. Let us include some mailbox money in there and then show you from a fee standpoint how much money we can save you versus putting this money with a money manager. I kept that, that's pretty good, what a trade. I promised 15 minutes, it's 14:59, boom, there we are at 15. So what we're gonna do, we're gonna open up the lines for questions, and then Trey, my favorite son-in-law, will be responding to those, and then Megan, if you can, as you get them, try to type them up here for us. If not, that's no problem either. So what's the best way to get questions?
Yeah, we've got a couple Megan had emailed in ahead of time, so she'll get those going. But again, just a reminder, use that chat feature there at the bottom of your screen to send in the questions you might have for Tony. We'll get to as many as we can. I think we had 4 sent to us ahead of time, so we're going to take care of those and fire away with the questions you might have.
Okay. All right, Tony, I keep hearing more and more about the age of 59 and a half as it regards my 401k. What's so important about that age? Now, it's funny, in my book, The Word for Retirement, I studied under a gentleman named Ed Slott. This book was written back in the early 2000s. I remember going to that conference. One of the things Ed Slott shared was, and I'd never heard of this again years ago, he said, by the way, make sure you review the plan document for something called a non-hardship in-service withdrawal 59 and a half. What is he talking about? So at lunch, I was embarrassed. I hadn't heard of that. I said, hey, what is he talking about? He goes, oh, yeah. If the plan document allows this, and our office will be happy to check with you, if you're 59 and a half or older and you're scared of the market and you want to move it to safer territory, we can confirm. And if it's eligible, most of them are, that can be rolled out into our process, into an IRA. There's no cost to do it, no taxes, because we're not really making a taxable distribution. And then we can look at it, and if you say, well, hey, Tony, I still want to contribute to the 401k because of a match, we can certainly do that. So that 59 and a half, really that deals with the plan document that governs your 401k. Does it allow you, even though you're still working, to move it out into your own individual IRA so you can control it? And most of them do, and we can help you with that. So you got another one there, Trey? See, I retired several years ago and left my money, well, this happens a lot, left my money with my previous 401k. Trey, you've been working with me sometimes. Why do you think people do this, by the way? Because they do more than you think.
They don't know any better.
There you go. So I can't really blame them. Think about it. If you're Joe Lunchbox and you've worked 40 years for some big company, and all of a sudden you're retired, and you're like, well, wait a minute, at least the 401k, I knew what I had, and the people seem nice. I don't know where to move that. I've gotten 64 dinner seminars, invitations this week. I've got phone calls. My internet's blowing up. I'm scared to death. I don't know who to talk to. This is a huge issue. But folks, as I learned through Ed Slott years ago, the worst thing you can do is let that thing sit there and fester. You've got a tax tumor buried in there. You've got taxes. You've got strategies that need to be involved before you turn 70 and a half. So, okay, so that's the rest of that question. I see. So what are the advantages of moving? Just what we talked about. Rather than leaving it sitting there dormant with no strategy around it, we actually want to roll that over. And in many cases, we're going to encourage you, while the tax rates are low, to spend it now, or set up a strategy to see if maybe we can convert that into tax-free money for you. So yes, if you've got an old 401k, I don't care what your age is, and it's still sitting at your former employer, please get with us. Let us talk about that. More than likely, we can put you in a better position than just letting it sit there. Let's see, I've done very well in the stock market and hate to miss out. Please assure me why I should consider moving some of my money out of the market. I can't. Sorry, that's a great question, but as a fiduciary, all I can do is point to evidence of the past stock markets. I can point to the dangers. What I would rather do is say, hey, what if we weren't in the market? What if all we made you was 2, 3, 4%, real conservative returns? But again, what if we cut your costs? What if we showed you how to use and enjoy your money? What if we included mailbox money? Then you might see the reasoning behind considering that. So no, I couldn't tell anybody. I had somebody the other day come in and say, I've got a bunch of my corporate stock, company stock inside my 401k. What do you think, Tony? Should I get out? I said, well, that's over 40% of your portfolio. I'm not about to tell you to sell that stock. Now, if you're asking what I do about my money, I'd probably temper a little bit, yes, because that's a lot in one stock. But so this would require us to go through an analysis. We would show you what we do, and then you can say, hey, you know what, I think I'd rather do what you're doing, or I'll just leave it where it is. That's your call. All right, next question. And in here, you talk much about target date funds. Do you recommend them inside my 401k? Do you offer them? I'm not, please don't
I'm not trying to talk down to anybody. I think this is the goofiest thing in the world. It's been proven that these target funds, maybe do you get a camera over here real quick, Aaron? Just so, okay, these are almost comical. Okay, so whatever, here, they even have the 2050. So what's happened is, here's my concern. I think the industry came up with these funds because basically they know people don't know how to pick funds. So the industry has said, well, I'll tell you what, if you think you're going to retire in the year 2025, am I on this camera still, Aaron's? Okay, okay. We're pretty informal here, folks. Thank you. If you're going to retire in 2025, we'll match you up with the right stocks and bonds for 2025. Like they know what's going to happen between then. Obviously, if you get farther out, if you think you're going to retire at 2030 or 2050, it becomes more and more risky is the idea. So less risk here because they're saying you might need it, you know, and whatever. And then it gets to more risk. And then it's kind of, you know, like a crapshoot or something, like a gambler way out here. Because the theory is, and it's a terrible theory, the theory is that you should be willing to take all kinds of risk because you're not going to retire to 2050. Well, who knows what's going to happen between now and then? And I've had a lot of young people that don't like risk. What does that mean? You're just supposed to take risks just because you're younger and retiring later? So again, folks, you got to sometimes question who came up with some of this stuff. It really makes no sense. We have another question here, or is that it? All the questions? No, we're finishing up early. So let's have a call to action. Well, we did have one.
Got another one coming in. It's from Dave. He said he has most of his retirement in a 401k, a small Roth. Do you recommend converting some each year into a Roth, especially if one anticipates higher taxes in the future?
Yeah. Okay, good question. So what Dave's talking about right now, again, factually, historically, we're at some of the lowest tax rates ever. I mean, this is a fact. So here's the point. It's like the old Frambo oil filter. You can either pay taxes now or wait to see what happens with the taxes and pay them later. Now, obviously, the way the Congress and the Senate and even the president's behaving here, taxes are coming down. The problem is spending's continually going up. This is not a good situation, folks. So in my view and in the views of a lot of economists and even former politicians, taxes are going to have to go up. There are 28 trillion, estimated $28 trillion right now in 401ks and IRAs that's not been taxed. So our strategy would be, let's consider paying some of those taxes now. Dave's point is well taken. One example of that is something called a Roth conversion. And yep, we know how to do those. Again, Trey, as you hear me say all the time on something like this, please don't rush out and just do a Roth conversion. Though there's a lot of issues involved, and we can help you think through that, whether you think that's a good idea. All right. Anything else, Trey?
Doesn't look like it. Any final questions? We'll give you another couple minutes. Again, that link there in the chat is how you can schedule a phone call or an appointment with Tony. So please feel free to click that. And then Tony is going to share our next upcoming webinar.
Yeah, we want to get a shot of that, Aaron. So yeah, on 2 weeks from today, noon sharp. And again, these only last 20, 30 minutes. The 5 misconceptions of annuities. This is going to be some really good stuff. As you know, I'm a big fan of annuities if used properly. Personally produced about as many as anybody in the country. So I've been using these a long time, long before most people really used them. I started using fixed annuities right after 9/11 when the money manager thing kind of went haywire. And we will have a question answer to follow. So again, to register, they can go and register for that now. Is it posted? Yeah, just go to Tony Walker.
That's on the website under educational opportunities.
Okay. Yeah, and by the way, a lot of people say, Tony, you used to do all kinds of seminars. Well, quite frankly, with technology, with the TV show, radio show, podcasts, we've got Renee doing a great job with our blog post. What's the best way? The blog posts are on the website now. The blog posts are really good. So we kind of feel like it's a better use of our time and yours. So in the comfort of your own home, doing things like this, get educated, figure out what's really going on. We're happy to share all that we know. I've been doing this 35 years. You know, we could run out and buy you a nice steak dinner and try to do the old sales pitch and the rope-a-dope, and that's not the way you want to handle your retirement, folks. That's scary. Learn as much as you can, attend these kind of webinars here, and then if you want to meet with me in person, I'll be happy to do that too. We'll go through an entire situation and assessment at no cost to you, so we'd be happy to do that. If you want to take advantage of that, do we have that up, Megan? Yeah. If you just go to TonyWalkerFinancial.com, you'll see a Let's Get Started. That information is confidentially sent to our office, and you'll be contacted. We can either meet or talk by phone. If we meet, I can meet you in the Bowling Green office, Louisville office, or, of course, in the Lexington, Kentucky office. Anything else? What's that? Megan, you got something else? Trey? No? We're good to go? Well, thank you so much. And again, don't forget our next webinar on the 5 misconceptions of annuities. And we've enjoyed it. Thanks for attending.